Hello and welcome to episode 429 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how are you doing? Welcome back.
Well, it's good to be back. You and I we've been separated for a couple of weeks because we each took time off with our respective families. I had a couple of days away in the UK, theme park, Alton Towers, went up towards the Midlands, but you did something a little bit more interesting than me, Andy, didn't you?
I went to Norway, that's right, on a cruise. So I haven't done a cruise with a family before. And it was with extended family as well. So it was with my mum and my dad and my brother and his family and my wife and my children. So it was fantastic. Great to get out and about. The weather was great. The cruise ship was fantastic. I came back glowing, didn't I?
You did, and almost sold the idea of a cruise to me because I've never been on a cruise and I've always wondered whether I would like a cruise or not, and then would it be crowded? But of course, listening to what you said and other people, in fact, I've known a number of people have been on cruises this year, and do you know what? I could be swayed on the idea of a cruise at some point, but it's good to be back at Money to the Masses, seeing the rest of the team. Actually, it's the first time the team have been together properly. Well, it'll be next week because one or two people are still off, and then we can all get back together. And actually, we're going to probably go out and have a bit of a social. It'll be quite nice too. So keep an eye out for pictures of that on our Instagram and other social channels.
So as you mentioned, Damien, we've been away. Last week was a bit of a special, episode 428. We're back in the office, in the studio. What have we got coming up?
So 3 pieces as usual this week. I've got an investing piece. This is about investing in the cheapest stock markets and sectors out there. So it's about finding value, and periodically I do a piece on this for 80/20 investor members, and occasionally I'll put it on the podcast. So I'm going to give you some insights from the latest piece of research and how you can take advantage of value. I'm also going to do a piece on NS&I. Actually have launched a new bond. They've updated their interest rates on their guaranteed bonds. I'll give you more details in the piece, but I think this is one of the times where this sort of product has become really interesting for a number of reasons, but particularly the interest rate. So if you have money sitting there in cash, or you know somebody who does, particularly you might have elderly relatives, then you'll want to listen to this piece of the podcast. And the other piece I'm going to be doing is regarding mortgages. So if you are struggling with your mortgage, let's say, for example, you've got a mortgage that you can't meet the payments, or you're worried about meeting the payments, but you haven't missed a payment. Now, there was a charter that came in which gave people access to support through their lender. I'm going to talk about the 2 options available to you, but compare the differences and the outcomes of those. So hopefully helping people in need make a choice.
Okay, so I'm assuming we're going to start with the investment piece as usual then, Damien?
Well, actually, I'm not. I'm going to do that one at the end. I just wanted to mix it up. In fact, a bit of a diversion, but we were talking about mixing things up in the office and about how when I read books, I don't like to break the spine. When I was on holiday, I decided to break the spine of my book. So I'm feeling inspired to break trends and routines that I have. So I'm going to do the investing piece at the end this week. I'm going to do the other pieces first. So I'm going to kick off with the mortgage piece, in fact. So if you are struggling with your mortgage or worried about your mortgage payments, then obviously you've got options available to you. You can look at your budget. I've done podcast episodes where we've talked about preparing for rate rises, in particular your own mortgage rate going up when you come to remortgage, about putting money aside. And that's what I did ahead of remortgaging, made a huge difference in my personal finances. So we'll put a link to that show actually, because it was incredibly popular, and it will help people who may not be remortgaging just yet, but could be among the million or so people that are going to be mortgaging over the next year, 18 months. But assuming that you've looked at the benefits that you might be able to get, the other help from the government that you might be able to get, then you're naturally going to be moving on to looking at your mortgage deal and speaking to your lender. And what happened is a few months ago, the Chancellor and the FCA effectively put pressure on mortgage lenders, and they created a charter. Now, 90% of UK mortgage market is covered by this charter. So a whole series of lenders signed up to this charter, which is all about giving people access to options if they are starting to struggle with the cost of living and their mortgage repayments. And what the charter did was give people access to more flexible options. So the mortgage lenders signed up to this, and they are now going to be giving people access to these options. And the 2 key options that you you've got, the choices are you can either decide if you are on a repayment mortgage to move to interest only for a short period of time, up to 6 months, or you could extend the term of your mortgage. Now, neither option will be adverse to your credit history. That was a key part of the charter because people were worried about taking action because they're worried that it would impact their ability to borrow money in the future. So this charter was trying to remove that pressure. So you can choose either one of those options and it will make your mortgage more expensive in the long run. I'll sort of explain that in a second. But you can choose one of those options and you can only use it once. And as I mentioned earlier, this is for people who haven't defaulted yet on their mortgage. So what I want to do is just talk about those two options because there will be people out there who'll be thinking, right, I'm worried about my mortgage payments. I want to take advantage of this new charter, my new options, but which one is best? So just to run through, if you temporarily switch to interest only, what will happen is that rather than paying back the capital when you make the payment, you'll only be paying the interest on your mortgage. So it will reduce your mortgage payments down. Now that will be for a period up to 6 months. And the idea of it is that you will, in that period, be able to sort out your finances. So then after the 6 months comes to an end, you can then afford the payments when you go back onto repayment rather than just be on interest only. But your payments will be slightly higher, of course, because you haven't been repaying your mortgage for that 6 month period. In a second, I'm going to give you some examples of the difference, but it's obviously going to be a relatively small amount because it's only a 6 month period. So you've got to be mindful of that fact. So the other option that you have is you can obviously extend your term of your mortgage. So you could go, for example, from a 15-year mortgage to a 20-year mortgage. And by putting your mortgage over a longer term, it will reduce your monthly repayments down. The thing is that on this option, you don't technically have to revert back to the shorter term, your original mortgage term that you had. So in the example I just said, 15 years, you don't have to go back to the 15 years after this 6 month period. You can do something in between if you want, but you aren't forced to. So you're going to have to talk to your lender about these options and about that at the time. But it does mean that you have a longer potential solution to a problem. But you've got to think about the longer term impact of that because you're now moving on to a mortgage that's got a longer term. It's going to make it more expensive. I'm going to run through some numbers over that longer period of time, but also it will change your options when you come to remortgage in the future, because one thing you've got to bear in mind is if you extend the term, then it may mean that you're going to have less options if you want to remortgage. And one thing that's worth pointing out, you won't be able to extend the term into your retirement. And that's understandable because obviously the lender still wants to have the money repaid. Now, this leads quite nicely onto a piece of news that came out this week. And we did an article on the Money to Masses website. We'll put a link to it in the notes as usual, that there is a trend for lenders to be extending their maximum term on their mortgages. Now, HSBC announced that they were extending their maximum term on their mortgage to 40 years. Of course, that doesn't mean you're going to get it because there are maximum age criteria that are involved in lending as well. So if you look at some of those, Halifax came out this week to say that they'd extended their maximum age that you could get a mortgage. It wasn't the maximum age up to, because they will lend up to age 80. It was the maximum age for the working part. So what age they would take your wages into account if you continued working. So that was pushed up to 75. Now, we'll put a link to some notes on the maximum age limits that are out there. Most of them have between age 75 and 80. So that will give you an idea, if you're thinking about these options and extending your term, that you may have that option even if you are older. So it is worth reminding that when that 6 month period comes to an end, when we're talking about extending your term under these new proposals, the term won't revert automatically back. You're going to have to speak to your lender, and there are still those limits that you still have to bear in mind. But there are options out there for people. So what does it mean in terms of pounds and pence? Now, to give you some examples, like I say, we'll put a link. MSC did a good piece on this, and they looked at different terms. But if we just take a standard 20-year term, £195,000 mortgage, the monthly repayments on that mortgage would be about £1,289 a month. If you went to interest only for a short period of time, for up to 6 months, your monthly payments would drop to £814. So you will save £475 a month during that support period. So that is obviously fairly significant. But of course, then when you end that period, then your mortgage payments are going to go not just back to the 1,289, they're actually going to go a little bit higher than that. They're going to go back to £1,309. You're going to be paying slightly more because obviously you haven't been repaying your mortgage for that 6-month period when you went interest only. Now, if you do the numbers and you work out what does it mean, the total cost of your mortgage over the term, assuming a 5% interest rate, well, they've worked it out to be £1,665 additional. So that is the option if you go for interest only. If you decide to extend your mortgage instead, now this will be an option that will be attractive to people who need help that lasts longer than 6 months. Because as I said earlier, then you can keep the term extended. You don't have to revert back. Now, assuming a £200,000 mortgage over 25 years, your normal monthly repayments will be £1,169. Your monthly payments during that help period, if you extended it by 5 years, that would take the payments down to £1,074 a month. So that's a saving of £95. But if you then revert after 6 months back to your term of 25 years, then your monthly payments will have jumped to £1,173. Okay, that's not a lot more than you were paying before. It's £4 more, but the total cost of that extension over the term of the mortgage, again, assuming the 5% interest rate, will be £433. So you can see that the overall cost to you is much lower than if you went on to interest only for a period of time. Now, as I mentioned, you don't have to revert back to your original term after the 6 months. If you stay on this new term, then in the example I've given, £200,000 over 25 years, you go to the 30-year term, your mortgage payments will stay at the new lower amount of £1,074. You were previously, if you remember, paying £1,169, but because you are now paying your mortgage over a longer term, the actual total additional amount you're going to have to pay is £35,758. So that is a significant amount of money. And of course, we're using the same assumptions, 5% interest throughout the term, which obviously you can't guarantee you're going to have 5% interest rates throughout the whole term. It could be higher or lower. So it's not a decision to be made lightly, but you can see there the options, and hopefully it will give people food for thought before they contact their lender. Of course, all of these are assuming that you have been keeping up with your mortgage payments. If you haven't, and you need to speak to your lender to see what options and help are available to you. If you take a repayment holiday or other options, it could potentially hurt your credit report. So that is going to impact your potential to borrow money in the future. And of course, if you are having problems with your mortgage, it is likely you're probably having problems with wider credit that you've got, maybe things like credit cards. Then there are charities you can get in touch with that can give you advice. So Step Change is one of them. And we'll put a link in the notes of this show so you can get in touch with them.
Okay, so we broke with convention then. We didn't do investing first, but let's do it now. Our investing piece, we're talking about stock markets and value in stock markets.
Yeah, so every now and then I do a piece of research for 80/20 investor members where I look at value. So a lot of the time we're looking at other ways of investing, including momentum, where you're investing in things that are working. Value is a different way of investing where you're looking at investing in something because it is cheap, but then with the aim that it will revert to its long-term value, this sort of mean. So there are times where things are cheap for a reason, but there are other times where things can become cheap, whether that's an individual company share, whether it's a sector, whether it's a country, entire stock market becomes cheap because investors fall out of love with it. And as a value investor, you might deem that actually, I think that is a good buy because you might have a view or know something that the wider market isn't appreciating yet. And then you buy into it. Then when the rest of the market catches up with you or things revert to their long-term averages, then you can make a significant amount of money. That's the aim. But of course, it doesn't always work out like that. Sometimes things go even lower. Warren Buffett is a famous value investor. So how do you apply it to your own investment portfolio? Now, there are ways that you can spend a lot of time looking at company accounts, but sometimes you just want to look at themes. You might be sitting there thinking that particular countries or sectors are unloved and they offer good value. So you might get, for example, a period of time like we've seen in recent years where maybe defensive stocks are unloved because everyone was buying technology and it was all about growth. But then defensives started to perform quite well during periods of 2022 when markets became nervous. But then technology stocks were expensive and therefore they were seemingly overpriced, and that would suggest that they could mean revert downward. So you might want to sell out of them. There is no guaranteed way of using value. Like I say, there are things like value traps where you can get it wrong. But if you want to look at what is cheap, and you might be using it in conjunction with other strategies or ideas that you have, then you might use it as a secondary reason to perhaps buy something. So let's think of it in terms of buying things in the shops, something you wanted, but then it's on sale, then you go and buy it because you think, well, that's good value. It's a similar thing with investing. Now, what I did is I looked at value across different sectors and countries, but how can you do that? Now, one of the famous ways that value has been measured is through something called price earnings. So they'll look at the price of a share, or they could look at a wider index, and they'll look at the earnings over time. Often it's forward-looking earnings, and they might look at the earnings per share and compare that to the price, and they come up with a ratio which is called PE, so P over E, and that comes up with a number, and by using that number and tracking it over time, they can see if that ratio is higher or lower than a long-term average. Now, there is a version of this ratio called CAPE, which is the cyclically adjusted price to earnings ratio, and that was actually created by Robert Shiller, who is a Nobel Prize winning economist. And what it does, it looks at the price of something versus the 10-year average earnings per share. So it really, all you've got to think about is, rather than trying to predict what the earnings would be in the future and then whether the current price was actually representing good value or not, you looked at the ability of a company. If we think about a company, their ability to produce earnings over the last 10 years, so in the past, and then look at the price today and use that. And so that was deemed as one way of finding value, and it was used to predict the US stock market crash in the late 1990s successfully, which is one of the reasons it came to more prominence. And so CAPE can be calculated. It's quite complicated, but you can find the number published occasionally for different markets around the world. So looking at those markets, what I want to do today, there's a whole piece of 80/20 investor research. You can take out a free trial and look at that research. And what I did is I looked at which countries were cheap and which were expensive, which were good value based on history, so they're par value. I looked at the sectors as well, because different sectors can become expensive or cheap based on history and represent value or represent them being expensive, but then looked at the funds that could take advantage of that. So that is something that's too in-depth for the podcast. So if you want to look at that, you can take out a free trial if you want to. But what I want to do on the podcast today is give people the areas where there is value, and therefore also give them some insight to say, look, if you want to take advantage of this particular country, then it is quite difficult because there aren't necessarily unit trusts that invest directly in that particular country. But if you find a fund that's got this amount of exposure to that particular country, then that is about as good as you're going to get, and that represents perhaps one way of investing in that particular area. So jumping straight across to the research. Now, I'm not going to run through all the different CAPE numbers because they're actually not important, the individual number. What's expensive and what is not is far more interesting. So strap in. I'm going to run through these at quite a quick pace. Australia is deemed as slightly expensive, as is France, India, and Spain. Switzerland, Taiwan, Turkey, and the US as stock markets are classed as expensive based on history. Areas where there's representing value are Brazil, China, Germany, Indonesia, Japan, Malaysia, Mexico, Poland, South Africa, South Korea, Sweden, Thailand, and the UK. Now, the UK has been interesting because since I've been doing this, it's always been deemed as pretty good value. So that is a market where you can find funds that invest in UK companies quite easily, because obviously we are the UK. And if you look at the sectors for unit trust, there's a significant number of funds that will invest in smaller companies that based on in companies that produce good dividends, and also just growth-based companies in the UK. Other areas that I've mentioned there, so other countries, you won't necessarily find unit trust funds that invest explicitly in them. You can find ETFs that might do, but it's very niche. But you might not want to do that. You might instead just want to build a diversified portfolio and have something like unit trust funds that have just a little bit more exposure to a particular area, some of the ones of value that I've mentioned, than the average global fund. Because if you look at most global funds, what you'll find is that they are predominantly based in the US. They invest mostly in the US, and that reflects the size of the US stock market compared to other stock markets around the world. So you have to go and dig a little bit deeper if you want to find something a bit different. So looking at the funds that I identified that invest in some of these countries that are deemed quite cheap. Brazil is one where you can find funds. They do inhabit the Latin America sector, and the global emerging market funds, they tend to have exposure to Brazil. So unless you get one or two of the explicit Latin America funds, which will have something like 50 to 60% invested in Brazil, the most you're going to get is about 10 to 13%. So if you get something like that when you're looking at a fund and doing your research, then that gives you a benchmark to know that this fund is betting on Brazil. If you want somewhere like China, of course, you've got Chinese equity funds. They've not been doing so well of late, but they do exist. There's a whole sector there. Germany, you're looking at European ex-UK funds if you want exposure to Germany, and anything over 20% is quite high. There aren't that many funds that have over 20% exposure to Germany, even though they are European funds. Typically it's much lower than that, but if you get 20 to 30, the most I've found is 30%. If you're looking for Indonesia, then you're going to have to look at Asia Pacific ex Japan funds, and again you're going to get most 10% exposure to that area. So if you're looking at funds and you see something like that, you know that is a bet on Indonesia. It's above average. Even the top ones, it's mostly around about 5% you're going to get. Japan, again, there is a whole sector for Japan funds if you're after one of those. Malaysia, you're not going to find anything above 1 or 2% if you look at a diversified fund. And again, you'd have to really be looking at the Asia Pacific ex Japan sector. Mexico is quite an interesting one because, again, if you go to the Latin America sector, you can find funds that have up to 30%. There's only actually 3 of them that have around about that, but most others, the most you're going to get exposure to Mexico is between 5 and 10%. That's quite high. Most other funds have much less than that. Poland, again, you're going to be fishing around in the European ex-UK, but also some global funds have exposure to Poland. And again, you're really only going to get 3 to 5% at best for that particular country. South Africa, then you're looking at more specialist funds or the emerging market funds, and the best you're going to get there is about 4 to 7% because it's an area that isn't heavily invested in with global funds. South Korea, you're going to see a lot more in South Korea actually because it's a bit of a tech play. So South Korea, if you look at Asia ex-Japan funds, some specialist funds have exposure to it, and you can quite easily get 13 to 20% exposure to South Korea if you want to. So you have to go and look for that. Look on your platform. You can look at individual funds, screen them if you can on different areas. Most of you can't do that actually, or look at Morningstar. So look at some of the funds that you like for whatever reason, look at their exposure. If it is anywhere in the ballpark that I'm talking about on this podcast, then you know it's quite focused on some of these value plays. And Sweden, we're again looking at European ex UK. You can get 10% plus in Sweden, so up to 20% is the most I've seen exposure to Sweden. And Thailand, and again, you're never going to get more than 2 to 3%, and that's looking at Asia ex Japan funds. UK, of course, you can find UK specific funds. Now, if we take the emerging markets generally, they are deemed cheap by CAPE. Europe is deemed borderline expensive, whereas global developed, which is being skewed by the US, is deemed as expensive. So just to wrap this part of the podcast up, if I had to look at the trends that have happened over the last year, then generally speaking, valuations have broadly become more expensive than this time last year, with the exceptions being China and the UK, which are both cheaper. Canada is one that remained unchanged, and despite the rally you've seen in German and Japanese equities, they still represent good value. So if you're looking for somewhere that's expensive, then US equities. And just because something is expensive doesn't always mean that it mean reverts. But if you believe in CAPE as a measure and potentially a predictor of future returns, it could be a sign that potentially you're going to hamper your returns over the medium term.
Okay, so the final piece of the pod this week, we're going to be talking about NS&I, National Savings and Investments. They were brought up on the podcast a couple of weeks ago where we were talking about premium bonds and the fact that they are now representing pretty good value based on their new notional interest rate because they gave it a bit of a prize fund boost. But we're going to be talking about a different product by the same company, NS&I, and why it might be attractive.
Yeah, so in all the years I've been in finance, and we're talking over 25 years, and you build financial plans for clients, and you would be talking about NS&I as part of that puzzle of solutions of where they could put their money, so they could put it in potentially things like premium bonds, but the other products that they have, for example, they have something called a guaranteed growth bond. And the thing was that the return that they could get was pretty dismal. And the real benefit of the product was the FSCS protection part. So there is no FSCS protection, the Financial Services Compensation Scheme, with these products because they are 100% backed by the government. So you won't lose your money. Unlike a bank, if a bank goes bust, you have to make sure you are covered by the FSCS for up to £85,000 per person per financial institution. And then you would get that money back if the company went bust. NS&I, you are 100% backed by government. So that was the attraction, but the rates were so poor. And so when you look at them, it's like, yeah, okay, NS&I, it's there, but it's nothing to get excited about. Well, I'm getting excited about them now because of this latest trend in their interest rates and making their products market leading and competitive. Now, this is deliberate because, as we know, there has been a lot of headlines about banks not passing on interest rate rises that have occurred. So when the Bank of England have pushed the base rate up, we've not necessarily seen that reflected in the savings rates that you can get at banks and building societies. But NS&I have now started to push up the rate on their own products, which is therefore in turn putting pressure on the banks and building societies out there to push their rates up. So it's basically increasing competition. And what happened this week, which is one of the reasons I want to talk about on the podcast, because I do think it's quite exciting, is that NS&I announced an increase to the rate on their 1-year fixed rate guaranteed growth bond and their fixed rate guaranteed income bond that they've brought to market now. And so you can get 6.2% gross on a 1-year fixed rate guaranteed growth bond. That is the best rate out there for 1-year fixed rate. Now, there are some 2-year, 3 and 5-year fixed rate bonds that they've got that pay 5.8% for 2-year, 3-year, and the 5.5%. These are gross numbers I'm quoting for the 5-year, but you have to be an existing customer, which is a key thing. So if you had a bond that was maturing, you could then use your money and put them into the 2, 3, and 5. But if you are a new customer who perhaps has listened to this or read about it, getting excited, you've got the option of the 1 year. As I said, that is the best rate. 6.2% gross is exciting. It is taxable, of course. But the thing that for me that I think is exciting, and a lot of people out there who may have come into some money, maybe it was a life event, maybe they got divorced, they may have had inheritance, maybe they took a lump sum from their pension, who could be sitting on sums of money, but they are mindful of the Financial Services Compensation Scheme limits. So you might have a few £100,000. You'd have to start trying to split it around different institutions to make sure you're protected. You can put in up to £1 million into one of these bonds. And so you could, if you had the money, put £1 million into this 1-year fixed rate guaranteed growth bond, get 6.2% gross, which is 100% secure because it's backed by the UK government. If you're happy to lock your money away for at least 1 year. Of course, after that period of time, we don't know where interest rates will be, but there are other options that you can have and you can shop around. But it does solve a problem for people when it's talking about the FSCS. I'm quite excited about it because it's rare that you get that perfect alignment of things where you can get a good return and your money is protected. Like I said, NS&I products in the past haven't been that attractive. They do have other products out there. They do have an instant access or easy access account that you can use. It doesn't provide as good an interest rate, but the guaranteed bonds are interesting. We'll put a link in the show notes so people can read more about them. You can actually open these products jointly, which is quite interesting. So you might have to manage your funds with you and your partner, for example, if you are married. Of course, as I mentioned, interest is taxable like interest on a bank account. You can use your savings allowance. Don't forget, up to £1,000. We'll put a link in the notes of the podcast to an article on the Money to Masses website that explains exactly how that works. I'm not going to go through it now because I'm conscious of time. But also, it is possible to earn an additional £5,000 a year of interest tax-free by the starting savings rate allowance. And that is based upon how much you earn. And if you earn under £12,570, it means you potentially can earn up to £6,000 a year interest without paying any tax. We'll put a link to an explanation of that in the notes of this podcast. I also thought it was interesting to bring to the pod because I think there are a lot of people out there who have largely dismissed NS&I, and now they're offering these market leading rates. They even offer the green bond, which we've touched upon in the past on the podcast, but the rate now is 5.7%, and it's a 3-year product, so 5.7% a year, and that will make sure that any money that you invest in that or put in that product is used for green things. So let's say, for example, clean energy or stuff like that. So that is something to look at as well, and I'll put a link to that in the notes too.
Very interesting stuff. And of course, Damon, you can open those online. So it's a bit easier than the old fashioned way of having to open up bank accounts and everything else.
Yeah, because it used to be the old days of checks and things like that. But NS&I are now obviously in the new age and you can do these things online.
Okay, so that's it. We're done for this week. If you want to get in touch with us, you can do so in the usual way. It's Damien@moneytothemasses.com. You can also send me a message. It's Andy@moneytothemasses.com. We're always looking for feedback on the podcast and also podcast ideas. So if you want something covered that we haven't covered before on the podcast, do send us a message. Please do review the podcast in the usual way. It helps us up the various charts. Just go onto your podcast app of choice and select the 5-star option. That would obviously be preferable.
Yeah, and you might get a Money to Masses mug and your review read out on the podcast. Don't forget to follow us on all our socials, Instagram, Threads, you name it, we are there. And don't forget to join our Facebook group, facebook.com/groups/money to the masses. So that is it, Andy. All there is to say is until next time.
Until next time.